So let's see, when should one buy the call option? If we are bullish, which means that the markets are going to go up, or the specific stock or the index on which you are actually buying the call option, if you think that it is going to go up in the near future before the expiry date of the contract, then you need to go and buy a call option. Okay. If you think it is going to go down, you are not supposed to buy the call option. You need to buy a put option, which will come later in this course. So the choice of buying the call option is only when you think the market is going to go up. Okay. But do remember that it has to go up before the contract expiry date. If it goes up at a later point of time, then you're still not going to make the money. All right. So let's see an example of this. Let's assume that there is a stock which is priced currently at rupees 200 today at the beginning of the month, and you think that it might go beyond 210 in the next 3 weeks. Okay. So what you do, you try to buy a call option for the strike price of 210 of that stock by paying a premium of say rupees 5 per share to the seller of the call option. Now there can be different scenarios out of this. If the price of the stock goes beyond 210, do you make the profits? Not yet, because you have already paid rupees 5 to the seller. So the break even for you is only when if the price of the stock goes beyond 215 in the next 3 weeks time. Okay. And if you see that the price of the stock is less than 250 by 3 weeks, then you are at loss. And what is the maximum loss that you can get? You will not get anything, and all that you lose is the rupees 5 that you have paid to the seller, and that is the maximum profit that the seller can take from you. Okay. So premium fee for 220 strike price will be less than the premium fee for 210. I hope you might have already got a sense of this statement, because the probability of the stock that is currently trading at rupees 200 reaching 210 is higher than it reaching 220, and it is also much lower. The probability of the stock reaching 230 or 240 in within 3 weeks time is much lower than what it is for it to reach rupees 210. So as you go farther away from the current market price, the strike prices premiums will keep gradually coming down. Okay. So it can be say 3 rupees per share. I'm just like giving you a number so that you can understand it. And if you go for 230, it could be just 1 rupee per share. Okay. But the probability of winning decreases as the strike price goes higher, and hence the premium fee goes down. Okay. So how about the premium fee of strike price 190, which is less than the current market price of rupees 200, and the premium could be even like say rupees 20 per share, which is much higher than the premium of rupees 210 strike price. The reason being, you are buying the rights to buy this stock at a price which is less than today's market price. Okay. So today the stock is at 200, but you want to buy this 3 weeks later at rupees 190. That's the reason you need to pay higher premium. Okay. All right. Now we have seen so far when are you supposed to buy a call option. Okay. Uh, the basic thing is, you are bullish about the stock or the market index for which you are buying the call option. In that scenario, you are going to go for buying the call option. But when do you want to sell the call option? You would sell a call option if you are bearish about the market or the stock or the index on which you are going to do the options trade. Okay. So if you think the price of the stock will not go beyond the strike price that you are choosing for which you're going to sell the call option, then you are going to opt for selling a call option because you think it will not cross that price. Okay, so let's see the example. Let's take the same example of the stock that is currently trading at rupees 200, and if we think that it would not go beyond rupees 210 in the next 3 weeks, then you go ahead and sell that particular call option, and there would be some buyer who is interested to buy this stock for rupees 210 by paying the premium fee that you are asking for. Okay, and you collect that premium and keep it with you, the rupees 5 per share, and actually you are going to multiply it with the lot size of the stock, so you're going to get a decent amount of money that you're going to collect and keep as the premium from the buyer. And if the price does not go beyond 215, okay, then you are going to make profit. So until the price stays below 215, which is the 5 rupees that you're collecting per share, that is also added to the 210 rupees strike price, so you get 215 is the break-even point for you to get the profits. If it goes beyond 215, then you start getting loss. And how much is that loss? It can theoretically be unlimited. If it goes to 250, you need to pay the extra 35 rupees, 250 minus 215, which is 35 rupees per share to the buyer of the call option. And if it goes to 300, then it will be 85 rupees per share that you need to pay the buyer. So theoretically, it is an unlimited loss for you. But if the price of this stock stays below 215, then you got to keep that rupees 5 per share with you as the profit. Okay, that's what this point is explaining. So what could be the premium for the strike price of 220? It will be same as, it will be less than the strike price of 210. And if you go beyond, it will be even more less. So the probability of you winning is higher because the probability of the stock reaching 210 might be higher than it reaches 230 in the next 3 weeks. So if you try to sell the call option of strike price of 230, there are higher chances that you will win. However, the profit also reduces at the same proportion. So you will only be collecting rupees 1 per share as your profit. But if you sell 210 strike price, which will give you rupees 5 per share as the profit that you can earn. But the thing is, the higher the risk you take, the more profit you get. The lower the risk, the lesser is your profit. All right. Let's see how about the premium fee for strike 190. Same concept, like when we are trying to explain the scenario where you want to buy the call option. Here also it is the same because we are dealing with the same call option of a stock that is priced at 200. So if you try to sell the strike price of 190 to a buyer, then you can collect more premium. However, the more premium you collected because of selling the 190 strike price call option is more riskier because the current market price has already surpassed the 190 mark. So as a seller, you might have pocketed more premium, but you are at a higher risk that you might end up in loss. All right. So now let's take a look at the summary of the call option that we have discussed so far. Call option buyers are bullish. They expect the price of the stock to go up. Okay. Call option sellers on the other side, they are bearish. They think the price of the stock will not go beyond a point, and they choose that point as the strike price and try to sell that call option for that strike price and collect the premium. Okay. The premiums of the call option for strike prices above the market price, the current market price, keeps decreasing. These are all called as OTM, okay, out of the money call options. This is a terminology that is being frequently used in the world of options trading. Okay, you need to be familiar with these terms so that when you read articles or when somebody explains these things over video or when you listen to some analyst speaking, then they will often use these terms. So you need to be familiar with these. That's the reason I've put this OTM, which is out of the money call options. So any strike price that is to the right side of the current market price, okay, which is greater than the current market price, all those strike prices are out of the money call options, okay. And similarly, any strike price that is to the left of the current market price are in the money call options, okay. So the premiums for out of the money call options are less compared to the premiums that are for the in the money call options, okay. And if the strike price is equal to the current market price of the stock or the index, okay, then it is called at the money call option, okay. Hope this is clear. If it's not clear, don't worry, I'm going to give you a cheat sheet through which you can remember this stuff and then can apply it easily when you're doing the options trading, okay. So let's move on.